The accruals concept is sometimes known as the matching concept. And this is the idea that we want to report events and transactions in the period to which they relate, rather than the period when the money is received or paid. So let me give you a couple of simple examples. The first is depreciation. If you buy an item of plant for 10,000 that you think is going to last for 10 years, although you're spending 10,000 in the first year, you're wanting to match the cost of buying that asset against the benefits that that asset will bring over a 10-year period. So you depreciate the asset. And if it costs 10,000 and has a life of 10 years and a nil residual value, you will depreciate, you will have an expense of 1,000, 1,000, 1,000, 1,000 every year. The purpose of depreciation is matching. The net book value of the asset is a byproduct. I don't really care about that after 2 years the net book value is 8. Yeah, what I care about is the reason we depreciated is the matching concept. Another example of the matching concept is deferred tax. So if you've got an accounting gain, a revaluation gain, which is not subject to current tax, the carrying value of the asset will go up, but the tax base won't. And therefore, you're creating a taxable temporary difference, which creates a deferred tax liability. Now, the double entry to that liability is an expense. So you've recognized an accounting gain, and in the same accounting period, you will recognize a taxation expense, the double entry to the deferred tax liability, thus matching the gain with its tax effects, even though no current tax has been assessed. So depreciation is an example of the accruals concept. Deferred tax is an example of the accruals concept. Cash flow hedges is an example of the accruals concept, because if you've got a cash flow hedge, you've created a gain or loss on a derivative, which you've designated to be a hedge, but there's no corresponding gain or loss on the risk that you're hedging. So therefore, the gain or loss on the hedging instrument is recognized on the derivative, is taken to equity, so it can be carried forward, so it can be recycled at a later date, to be matched in the future when the gain or loss on the hedged item arises. So although the accruals concept is a simple concept in the context of depreciation, it can also be applied with deferred tax and used to explain things like the accounting treatment of cash flow hedges. The gain or loss on a derivative, if it's a cash flow hedge, is not taken to the P&L. It's carried forward in equity. It's recognized in equity, in OCI, so it can be recycled later to be matched with the gain or loss on the actual item. Thank you for listening.